Ladies and gentlemen, I'm very pleased and honored to be asked to give the IFORS lecture at this conference. I've enjoyed attending these conferences for more than 30 years and have seen them grow in size and in reputation. The topic of my lecture today is credit scoring and the other models associated with estimating default risk in consumer lending, how they performed during the subprime mortgage crash and the subsequent financial crisis, and what lessons can be learned that are pertinent to operation research modeling in other areas. This conference is celebrating 50 years of decision analysis, but it's also an appropriate time and place to celebrate credit scoring. It's appropriate in time because 100 years ago was when Western Union developed the first charge card. Of course, it wasn't plastic. And it's appropriate in place because it was in San Francisco 58 years ago that Bill Fair and Earl Isaac set up the company that bore their name and is now FICO. Fair Isaac's aim was to use data to improve business decisions. They recognized that assessing consumer default risk was an obvious area, and credit scoring was developed. Their first customers were mail order firms like Montgomery Ward, and it took until the 1970s before banks realized that the expansion in credit cards meant a model-based automated system for accepting or rejecting applicants was essential. Its success meant that credit scoring quickly became used for all forms of consumer lending. If I were to ask you when consumer credit began, I suspect some of you would have said with the advent of credit cards, or at least in the post-Second World War period. You might be surprised to find the first reference to consumer credit was more than 4,000 years ago. In Babylon, with farmers borrowing money from priestesses to buy seeds and promise to pay them back at harvest time. In the Middle Ages, there was a long debate about whether one could charge interest on debt or not. It was got round by saying interest was okay, but lots of interest was bad, and calling the latter usury and blaming it on others, or at least the merchant of Venice. Nowadays, I guess he would be called a payday lender. In the 1920s, it was car manufacturers like Ford who invented finance companies so that consumers could borrow the money to buy their cars. Of course, after the 1950s, the real boom in consumer credit started. And as people became more mobile and so had less relationship with the lenders, the need for credit scoring grew. This graph shows the exponential growth in US consumer borrowing since the 1950s. Even the recessions, which are the shaded areas, have made little impact on this growth. Now more than $3.25 trillion is owned by consumers in the US. The basic philosophy of credit scoring was shaped by its original application. It predicts, not explains. And so anything that is predictive and legal, but is not prohibited by the Equal Opportunities Credit Act, can be used. It predicts a specific default risk, usually whether a borrower will be 90 days overdue in the next 12 months. And it assumes this risk is time invariant. So it uses the performance of a sample of applicants over the past few years to estimate the risk of future customers. It also means that until recently, it has not involved macroeconomic variables. Credit scorecards can be thought of as a classification system and are developed by taking a sample of previous applicants for credit scoring or previous borrowers for behavioral scoring. Each person is then classified as a good if their payment history is acceptable, or a bad if it is unacceptable and breaches the 90-day overdue limit. Some borrowers who are 30 or 60 days overdue may be classified as indeterminate and ignored. The set of borrower characteristics are then split into two, one set being composed mainly of goods and the others of bads. And new applicants falling into the first set would be accepted, those falling into the second set rejected. Usually, as in the diagram here, this split, oh no, can we go back one? Yeah. This split is done on whether the borrower's score, a linear function of the characteristics, is above or below a cutoff score. With the advent of the Basel Accord, which requires banks to estimate the default risk of individual loans, one needs to change this score into a probability of default for the individual loan. This is easiest to do if, in fact, it is a log odds score, that is, the score is the log of the odds of being good to being bad. The most common method by far of building scorecards is to use logistic regression, which has the additional property that it gives a log odds score and leads to a linear score function. In the 1970s, linear regression was used because it needed far less computing power, and it still can be used now to cut down the number of characteristics, which in some cases can number in the thousands, to a manageable set of the most powerful ones. Classification trees are sometimes used to determine which segments one needs to build different scorecards on. Two other features that are special to scorecard building are coarse classification and reject inference. Research papers have suggested many other classification methods. Though some of them, like ensemble methods, can produce a slightly better discrimination than the standard approaches, they have not taken hold because of transparency and robustness issues. In several countries, you have to give reasons for rejecting someone for credit. And saying the neural net said no is not an acceptable reason. Similarly, some of the methods are overfitting and do not perform too well in out-of-time samples. More recently, survival analysis, particularly Cox's proportional hazard approach, have been used because they allow estimations of default over any time period, not just the next 12 months. One of the origins of the global financial crisis was the need for banks to find new sources of finance to fund their lending. Until the end of the 1970s, bank lending and deposits grew in line with one another. But the subsequent huge growth in consumer lending was not matched by a growth in deposits. The green line in this graph is the annual increase in mortgages. That's averaging about 20%. The blue line is the annual increase in bank deposits, and that's averaging about 5%. At the same time, the trade imbalance between China and the US meant China had lots of dollars to invest in the US, more than the US Treasury needed to fund its AAA-rated sovereign bonds. So there was a need for AAA bonds, and the development of residential mortgage-backed securities fulfilled that need and also gave better returns than other AAA bonds. Since the Depression of the 1920s, the US government, through the setting up of Fannie Mae and Freddie Mac, have developed the use of mortgage-backed securities to help fund mortgage lending. One created a bond whose income came from the repayments from a pool of mortgages. The bond was split into tranches, and the investors in the highest tranche had to be paid before those in the second tranche, and so on. The ranking of these tranches related to the chance the investor in that tranche would not be repaid, and so the top tranche would have a higher rating, usually AAA, than those below it. However, Fannie and Freddie only accepted prime mortgage into their pools. That is, ones where the borrower had a high credit score, full certification of his income, and the loan was for owner occupation for not too high an amount, and the loan to value and the debt to income ratios were reasonable. Investment banks saw an opportunity to securitize subprime mortgages, so they would not be in competition with Fannie and Freddie. As the graph shows, in 2001 to 2006, there was a boom in the level of mortgage-backed securities, which was mainly in subprime mortgages. In 2001, there was 120 billion of prime mortgages, that's the green part, and 130 billion of subprime mortgages, all the other colors. By 2008, the prime mortgages had increased 50% to 190 billion, but the non-prime mortgages had gone up 700% to 960 billion. Some banks even bought mortgage brokers so as to find the mortgages for the securities. Talk about putting the cart before the horse. And then, of course, the housing bubble burst, and borrowers started to default, either because the value of the house was below the value of the mortgage, or because the borrower could not refinance the mortgage on the attractive terms they had had previously. It was also the case that in order to keep the flow of mortgages coming, lenders had started to drop their standards, particularly in 2006 and 2007. This graph shows how the early default rate started climbing in those years. Notice the blue and red dotted lines, which are the 2006, 2007, are much higher than the previous years. Although there were signs of problems in 2007, with some subprime lenders collapsing and hedge funds failing because they could not value or sell their mortgage-backed securities, the real crunch came in September 2008. Two of the largest investment banks went bankrupt or were taken over. The largest mortgage company was also taken over, and the government had to bail out Fannie Mae, Freddie Mac, and the largest insurance company whose policies were supposed to protect the high tranches of the mortgage-backed securities. There was similar carnage in Europe. Cartoonists had a field day, but the impact precipitated the global financial crisis and the demise of many financial institutions. There were two models involved in the crisis. The first, credit scoring, was used by lenders to assess the risk of applicants defaulting on their mortgages. Many lenders used the credit bureau scores, which assessed the overall default risk of the borrowers. The second type were the models used by the rating agencies, particularly Standard & Poor's, Moody's, and Fitch, to rate the tranches of the mortgage-backed securities and the CDOs, collateralized debt obligations. You'll realize I'll call them CDOs from now on. They became mainly composed of tranches of mortgage-backed securities. You may think of CDOs as an example of the aphorism of making a silk purse from a sow's ear. One took the lower tranches, say the ones rated BBB, from a number of mortgage-backed securities and pooled their income in a bond. This bond was again split into tranches, as was the case with the securities, and investors bought different tranches. It turned out that the top tranche of the CDOs were rated AAA. So how did these models perform? Well, the credit scoring models continued to work well in ranking borrowers in terms of their 12-month default risk. The difficulty was the lenders had changed the problem. Moreover, the credit bureaus continued to use the same static scorecard even when the economic conditions were changing considerably. The lender's objective became to acquire mortgages and then immediately sell them to be securitized. Since they only held the mortgage for a month, there was no chance of the loan defaulting, and so they were not interested in what the default risk over the first 12 months was. What was wanted was to make the credit score high enough to securitize the mortgage. It was in the borrower's interest to inflate his score so as to get the loan. It was in the lender's interest to get an inflated score to get the highest rating for the security. So we had liar loans where the information was incorrect, and in the extreme, ninja loans where the borrower had no income, no job, and no assets. Although the details of the bureau scorecard were confidential, one could freely obtain one's score online. By looking at how changes in information changed the score, people could work out how it operated, and a new profession, score doctor, was invented. They guaranteed to improve your score for a fee. The problem with bureau scores arose because of the tradition of time invariance in scorecards. If we consider a log odds score, where the score is the log of the odds of being good to being bad, then Bayes' theorem can split the score into a population odds score and so a population odds score and a weight of evidence score. If you assumed that the weight of evidence score was independent of t, which is not unreasonable, then of course the scorecard was essentially the population odds score, but at the time when the scorecard was built, plus the weights of evidence. So in a sense, it was independent of time. What you really wanted was the scorecard at time t to be the population odds at time t. And so you should really have adjusted the scorecard by this difference in the population odds. In that case, the score would have dropped if the default rate is rising, and the score that defines a prime mortgage should stay fixed over time. Turning to the second set of models, those used by rating agencies to rate the tranches of mortgage-backed securities, the only conclusion is that they were wrong. Some of the problems were identified by the Security and Exchange Commission report, and others followed because the model methodology, which was imported from their rating of corporate bonds, was inappropriate. The objective was wrong, the data sampled was inadequate, and particularly for CDOs, the use of corporate model parameters was inappropriate. The results were spectacular downgradings of the ratings, with $11 trillion worth of AAA mortgage-backed securities downgraded. 92% of those issued in 2006 were downgraded within a year. The graph shows the results for the CDOs rated in 2006 and 2007, the red and the blue, for different grades. For some grades, up to 80% were downgraded to junk bond status. These results were so bad that the Securities and Exchange Commission investigated what had happened to produce such incorrect ratings. They found the process started by estimating the default probabilities of the various mortgages in the mortgage-backed securities pool. The different agencies used different approaches: logistic regression, hazard rates, and a static factor model. They all used loan and borrow information supplied by the originator at the time of origination of the loan. Loss given default and cash flows were also estimated. Then Monte Carlo simulations of the performance of the portfolio of loans under different economic conditions, mainly different interest rate changes, were undertaken. The report found that the results of the modeling were sometimes adjusted after comparing them with recently issued securities. The SAC report highlighted other issues which affected the way the agency rated securities. Firstly, there was the conflict of interest, because it was the issuer of the security who paid for the rating, not the purchaser of the security. This was exacerbated since 12 issuers accounted for 80% of the securities issued. The agencies did not want to offend them since there were rival agencies able to do the same job. Moreover, the growth in rating, particularly rating CDOs, was not matched by a growth in the number of analysts involved. The models were rarely updated and used old information, even though what was being rated changed a great deal. We talked about the value of subprime mortgages going from 190 billion to 960 billion in 6 years. And in 1 year, 40-year mortgages went from 0% of the mortgage pool to 40%. Loss given default was based on 2003 data when house prices continued to grow. The model of any specific security was only updated if the security had problems paying the tranche holders. Even though there were monthly updates of the behavioral score from the bureaus, that is the current default risk of all borrowers in the pool. CDO models seem particularly weak, including only 5 pieces of information about each component, compared with 60 pieces on the mortgage and the mortgage-backed securities. The tranches of the CDOs even use the default rates of equivalently rated corporate bonds. There were few previous models of default risk of portfolios of mortgages, and in fact the Basel Accord had to use the Merton model of corporate default risk for all types of lending. Using the ideas from corporate bond models leads to problems. Specifically, the ratings describe the wrong objective. They describe the unconditional default risk, namely what happens through the economic cycle on average. What was needed was the default risk when the housing market was under stress. Such modeling errors were enlarged because the model also was made use of to structure the security so as to maximize the size of the senior tranche. Also, the data gathered, although fine for corporate loans, was insufficient to get good estimates of the parameters needed for the residential mortgage-backed securities. Securitization involves idiosyncratic risk and leaves systemic risk, which means one needs data from lots of years, not lots of data from a few years. Some of these issues can be shown using a very simplified model of the default risk of mortgage-backed securities, which was suggested by Eric Heitfield. Assume the pool has N loans, all of the same value and with a constant LGD, and an unconditional default probability of 0.1. This means that the probability of default distribution and the loss distribution over the tranches are essentially the same. For each loan, we think of its creditworthiness Y as the sum of a systemic factor X and an idiosyncratic factor U. If those both have standard normal distributions, so does Y. We assume default occurs if Y falls below the value, which gives you a 10% chance of the normal distribution being below that value. So in that case, the independent and unconditional probability of default is 0.1, but the conditional probability of default depends on the value of the systemic factor X. We assume that the senior tranche started to default if the losses became at least L% of the mortgage pool, and we get probability out of default of the tranche by simulating this many times over T years. This shows the effect on conditional and unconditional default risk on whether it's worthwhile having 1 loan or 100 loans in the mortgage pool. For unconditional default, this shows that the table here shows that diversification, increasing the number of loans, is good. Since the normal distribution has a lower variance and so it does not spread into the region where there would be losses. So the diagram there is trying to sort of say that the lower one is when you've got lots of loans, a thin variance, and so you don't sort of go into the bad region. With one loan, you do. For the conditional situation, if you just put one on, you see the lower table there, and in fact, everything is now reversed. And the reason why it's reversed is because now the mean of the distribution is in the bad part rather than in the good part. So if you press once more, suddenly you get something like that happening. And now it wasn't good news to have a narrow base because all the probability distribution is now in the bad part. Thank you. The second point to make is that it is the number of years, not the amount of data, that's important. Running a number of simulations shows that as the number of years increases, the standard deviation of the estimates gets smaller, though the mean does not change. So if you look down the third column there, the standard deviation, you can see that that actually goes down as the number of years changes, both in the first case when we have the senior tranche and in the second case when we have a portfolio of loans without this sort of connection about the mortgage-backed security. The rows that are highlighted, though, show that one needs 30 years of data with the senior tranche to get to the same volatility as 5 years of data for the portfolio of loans. So what that is saying is that with a senior tranche, because in a sense you're sort of far out in the distribution, you need a lot more data to see the unusual years than you do with a normal portfolio of loans. Thank you. This cartoon makes the obvious point that housing defaults are highly correlated and hence the need for the conditional risk objective. So what are the lessons that one can draw from this that are of use to operation research modeling in general? They may not be the 7 deadly sins, but there are 7 lessons that I think you can draw. Firstly, make sure the model objective is relevant to the decision maker. Modeling the default risk over 12 months is irrelevant if the lender is only keeping the loan for 1 month. In extreme cases like this, it was no longer that the model reflected the decision, but the decision reflected the model. The decision maker was only interested in a high credit score. The second lesson is whether a static model is sufficient, or does one include the dynamics of the situation. The Bureau credit scorecard stayed static until 2008. And yet the economic situation and housing market were changing rapidly. It is extra work to include dynamics into a model, but sometimes it is essential. The third lesson is that making the models public means the models will be game played. Allowing the public to find their score on the internet meant score doctors worked out how to improve scores. Our culture says making information available is a good thing, but is a model robust enough to cope with the subsequent game playing of those affected by the model, and is their behavior what we want? One bank I knew could only use bureau information in its credit card scorecard because it had incentivized its staff to sell such cards. They quickly learned what information would guarantee an applicant being accepted when they filled in the application form, and so suggested suitable answers. That invalidated all those characteristics. We shouldn't feel smug about this, because the academics in this audience are also involved in such model game playing. In countries where there are research assessment exercises, star researchers are imported for the minimum time required by the regulations. Academic promotion depends not on the quality of the papers, but on the rating of the journals they are published in. So there are now long waits for publication while authors work their way down a journal list. while the growth of the subject is being skewed by the interests of the perceived top journals. On the other hand, some journals suggest papers cite references from that journal to improve their rankings. We have left the next generation of researchers an unfortunate game to play as far as publications are concerned. In a different area, punctuality of trains in the UK is measured by the percentage of trains that arrive at their destination within 5 minutes of the published time. So what happens is that late trains stop one station before their destination. Don't count anymore. Others don't stop at stations to make up time and leave the passengers there stranded. Changing to percentage of passengers would mean the strategies and maybe would be slightly different, though probably not much better. The fourth lesson is self-evident. Verify the data used in the model. That didn't happen with the rating agencies, and the originators who supplied the data had incentives to inflate the credit quality of the borrowers. The SEC earlier this year adopted new rules to tighten up on this. The next lesson is that if one knows updated data will become available regularly, the model should be built so as to take use of it. Ratings were seen as a one-off calculation using the information to origination. Yet there were monthly updates as the bureau scores of the mortgage borrowers became available. These scores would have given early warning of the deterioration of the securities built on those mortgage pools and would allow the agencies a chance to readjust the ratings. Yet the models were not built to take advantage of that information. One lesson from the rating model disaster is that extrapolation of a model beyond its original application can be dangerous. Rating agencies use the methodology of rating corporate bonds, if not the exact model, when rating mortgage-backed securities. They did not recognize the difficulties that can arise. Again, this is an example where the model objective was not appropriate. For mortgage-backed securities, one wanted the default rate conditional on a stressed housing market, not the unconditional risk. Moreover, one needed different levels of data, not just lots of data, but data from lots of years. The final lesson is a salutary one for all model builders. If a model disagrees with your common sense, think again about the model. In the case of CDOs, how could putting lots of risky loans together lead to a riskless tranche of the CDO? Securitizing mortgages into the mortgage-backed securities got rid of the idiosyncratic risk, so CDOs can't get rid of it a second time. Granted, models are useful for giving new insights into a problem. But if the new insights are in contradiction to the old, be sure the model is okay. I'm sure that you adhere to most of these lessons yourself, but it's worth remembering that if you do not, you may well wreck the world economy for a decade. Thank you for listening.